Welcome to the Live Squawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary.
Good morning, good afternoon, and good evening, wherever you may be listening in. And thank you for joining us today. This is welcome to the Live Squawk preview stream, the last of the year. And as my North American friends say, it's going to be a doozy. Basically, because I've got two very well qualified guests on today's show, taking us through what to expect ahead of today's FOMC meeting. We'll also then look on the US outlook, and we'll go into also Bank of Japan and Bank of England rate decisions. We'll touch them lightly, but we'll go into what's likely to come from there as well. Apparently my microphone's really crap today, so apologies for that. I don't know why it suddenly decided to play up, but I'll try and do my best to talk less and let my guests talk more, and hopefully we can get some good quality content out of today's show. As I said, we'll also examine some of the expectations for the year ahead, and we'll finish by previewing the key interest rate decisions from the Bank of England and the Bank of Japan. But primarily, we are looking at today's FOMC meeting and what to expect. So I'll go through some of the ranges and so forth in a second. Before we get to it, some legal stuff. The content provided on this channel is for informational and educational purposes only. I am not a licensed financial advisor, and none of the information shared should be considered financial, investment, or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making investment decisions. Investing and trading in financial markets carry risks, and past performance does not indicate future results. Live Squawk is not responsible for any losses or gains that may result from the following content on this channel. As I said at the top of the show, to help me navigate central bank rate announcements and what they mean for market participants, I am joined today by a regular contributor, Joseph Choi of the Curve Advisor, a well-regarded financial market blogger and trader. You can find his analysis on Substack. And joining us is Sam Cutler, a portfolio manager. Sam started his career as a professional golfer at the age of 20, I didn't know that, competing on the Canadian, Latin American and European tours. Unfortunately, after sustaining multiple shoulder injuries, he was forced to hang up his clubs. He then found himself on the floor of the Amsterdam Stock Exchange, trading cash equities for a proprietary firm. Quite a journey, and I think I'll probably take a whole show to go through that and unpick that on myself. In February of 2024, he joined ARB Asset Management and launched 333 Capital, a discretionary micro fund. Welcome, guys, and thank you for joining me today.
Hey, Henry, thanks for having us.
Good stuff. Right, before we get into it, I'm going to go over the ranges ahead of tonight's FOMC, just to give people just a bit of a view, and then some bank research. So tonight at 1900 GMT, 1400 Eastern Time, we've got the FOMC interest rate decision. Consensus is that we'll see a cut of 25 basis points, which will take it from the previous range of 4.5% to 4.75% to 4.25%, 4.5% target range. Then 30 minutes after that, at 1930 GMT, 1430 Eastern Time, Chair Jerome Powell press conference will begin, where he sits down and explains and takes questions from press. So yes, on the back of that, just a quick note here. I've got one from JP Morgan that says, with the lowering of the target range for the Fed funds rate, a near enough foregone conclusion, Michael Froley of JP Morgan said, we don't look for major changes in the statements, language, or the forward guidance, even though we still think a pause is likely at the January meeting. We think that the economic forecast will show better growth and firmer inflation this year, and that the median estimate interest rate forecast dots will be revised to show 3 cuts next year instead of 4, as in the September dots. We believe the longer run median dot could move up to around 3% or slightly higher. In the press conference, we expect that Powell will stay away from the strong signaling about January, and that he will also avoid specifying which policy assumptions are embedded in the committee's economic forecast. We do not expect any dissents, but we do think there could be a 5 basis point technical adjustment in the overnight reverse repo rate. And with that, guys, I'll start with our new guest, Sam. Sam, what are your initial thoughts on today's?
Yeah, so Henry, I mean, I think it's pretty clear. The market's perfectly priced here for a 25 basis point cut, and I think the main deciding factor for that was last week when we got obviously the CPI and PPI prints. Right, we don't have core PCE yet. We won't get that till this Friday. But when you have CPI and PPI, you can fairly piece together the components to forecast what that core PCE is going to be. And based on last week's data, we pretty much see core PCE right now coming in at about 13 bips month over month, right? And that's kind of right in the middle of the street estimates where they range from about 11 to 15 bips on the month over month. And if you take a look at the last PPI print, right, some of the main components that feed into the PCE are portfolio management fees. Those dropped to about 0.6% from 3.1% in October. That was a little bit surprising to me just because we have had fairly decent positive equity market momentum. And typically when you see positive stock returns, you're typically going to get a positive contribution from portfolio management fees. Another large input is airlines, right? And those fell to 2.1% from last month's 2.6%. This was still a little higher reading than you normally see, but that could, kind of been around the Thanksgiving travel week with TSA checkpoints up. I think it was about 3% on that week. Regardless, airfares, they've been trending lower all year versus last year. And the same thing with hospital prices. That's another major input. And those have been relatively well behaved. So I don't think the rate, everyone knows it's going to be 25. Everyone's going to be looking at kind of the dot plot and the Fed's forecast for some of these key economic data, right? So I think in regards to the forecast for core PCE, they're going to bump that up, right? I think we're going to be looking at about 2.8 to 2.9% for year end versus the previous 2.6. And obviously the unemployment rate has been surprisingly steady. And I believe they had that at 4.4% for the year end. I think they're probably going to pull that down to 4.3%, and likely GDP gets like 50 bips higher, right? So let's call it 2.5 versus that 2%. Fed funds, I think it's actually going to be a little bit more dovish than the market is expecting, right? I think Fed funds for the end of 25 should come in around 3.6% and right around 2.9 for the end of 2026. So that kind of gives us 75 bits of cuts in 2025 and 75 bits of cuts in 2026. And that's versus the previous 100 bits priced in for 25 and the 50 bits in 2026. As far as the presser goes, right, I think Powell, he's never going to explicitly hint at a pause, right? And every time you think Powell's going to come out and be hawkish, he comes out and sounds even more dovish than you could have imagined, right? So I really don't think he's going to signal any type of pause. He's going to, obviously have the same narrative, data dependent, economy is performing well, job markets, coming into better balance. But I think they're really setting up for those 3 cuts next year to materialize, and they're going to do it on about a 12.5 bips of meeting. So it means they're going to cut every other meeting. So we can kind of expect a cut in March, June, and September is what I'm kind of thinking here, right? And the reason I think this is they have to kind of stay somewhat balanced as unemployment has undershot their forecast, but inflation has overshot. Right. And I think another reason they need to lean a little more hawkish is the fact that the debt this cycle is coming from fiscal and not private. Right. If you look at real rates, they're still relatively restrictive, pretty much to a similar level back as they were in 2007. But the problem in 2007, a lot of the debt on the balance sheet was concentrated in the private sector. Right now, it's more of a fiscal problem. So the economy can essentially survive on higher rates, right? And I think a lot of people are struggling with this because they're asking, why even cut? You have, animal spirits essentially running wild, inflation expectations are rising, and I think you have to take a step back and think about the dual mandate, right? It's employment, price stability. The Fed has brought inflation down from 9% to 2.7, while also slowing the labor market, right? Now, these are the problems that I think the Fed sees. I don't know if the animal spirits in the market are quite seeing these yet, but I think employment is a little weaker under the surface than what most are seeing, right? You look at the job finding rate, that's kind of collapsed over the past 2 months from right about 30% to the very low 20s right now, right? So I think this is the reason the Fed's dot plot is going to be a little more dovish than what the market is expecting, right? The headline payrolls, right? If you look at private job creation on a 6-month average, it's sitting right around 100,000, right? And we do have the unemployment rate moving slightly higher. So I think that's going to keep them on the rate cutting path.
Right.
And then
just to try and unpack some of that right now. So in terms of, we've taken a look at the data and some of the forecasts, but we do have these data coming up in the near term, and we are looking for that. I think the core PCE rate annually is looking to rise to 2.9 to 2.8 last month, and that's if we look at the final GDP print for core PCE in the quarter, they had it to core price index of 2.1%. And looking at it confirmed in the last in tomorrow's GDP final review. I just want to get Joe and see what his regarding and what he takes around this decision. It's not mid decision in the US. Joe?
Oh, yeah. Well, I think Sam gave a good summary on the expectations. I think the last SCPs showed how misleading it could be in terms of trying to predict Fed policy path. In September, the Fed dots showed a close call between 3 and 4 eases this year. And it was only 1 dot away from being 3 eases. And the Fed thought GDP was going to be 2% by the year end, and it'll probably be like 2.7 or so. And the unemployment rate would be 4.4, and it's currently 4.2. And core PCE would be 2.6, and it's probably going to be 2.8. And yet we're over 95% price for another ease. So I think it just kind of goes to show that while we do care how the Fed projections come in, it doesn't necessarily translate into being able to predict what the Fed policy is actually going to be. And then I guess the one thing I'm curious about at this, before the press conference is to what extent the FOMC takes into account Trump's policies. I mean, they claim they don't, but it seems a little myopic to not somewhat factor in probably what's going to be the biggest events of 2025. And the other thing is I think when you have uncertainty in policy, you can't have much confidence or as much confidence that the inflation will keep going lower. So I actually find that kind of interesting. And then I guess the last thing is I have a slightly different take on Powell. I think Powell probably will sound a bit hawkish. So I know he'd sounded dovish in the past, but I have noticed that when the beige book comes in weaker, Powell sounds more dovish. And when the beige book comes in stronger, he tends to sound a little more hawkish. So I think the markets are somewhat correct in having sold off going into this meeting because, the last beige book was somewhat supportive. I think the Fed relies on the data, but they also rely heavily on this anecdotal information that you get from the beige book and other contacts that they have in the economy.
So thank you, Joe, for that. So just based on what I'm unpacking from what you heard you said here. So obviously today's decision, done deal, 25 basis point cut. But in terms of what we're looking for next year, maybe 3 cuts to be priced in by market participants there. But you don't really, I think Powell has said himself, we shouldn't really wholly rely on the dot plots as your guide for the policy path. But in terms of the thinking here, you think it's the markets are ahead of themselves again a little bit on this one, and to pare back those expectations, really, or just trying to understand the expectations for policy moving forward. The markets are a little bit offbeat, or is that is that what you're really sort of saying about policy looking down the line? Sam, sorry.
Yeah. So I guess in terms of 2025, it looks like most forecasters are assuming that inflation is going to go back towards closer to 2.5%, and growth is going to get back to 2%. And it's not clear to me that those are good assumptions to make. Just because I think we're going to have a change. I mean, this change in leadership in the United States, I think, is going to play a big factor in, the trajectory of both growth and inflation. And I guess I just don't have that confidence that, we can assume things will be back to the status quo from 2016 because we had seen them before. Because I think a Trump in his second term, where he doesn't have to run for election again, plus having control of both houses of Congress, I think we can see some unexpected things, whether it's on the fiscal side or just in terms of him trying to negotiate policy. And so
Do you not see a more considered Trump in terms of, again, for the very reasons you just said, he has everything under his control. He hasn't got to fight internally, which is apparently one of the issues he had in his first term, where he was always fighting for legitimacy within his own administration. He hasn't got those worries now, so he doesn't have to be knee-jerk. He doesn't have to be as reactionary. He can lay out his policy and his path, comfortable in the knowledge that it's not going to get usurped, it's not going to get undermined by people from within. Is that not a fair sort of assumption?
Yeah, so I think that's why the Fed dots and the market pricing have disconnected somewhat. So I realize that the Fed are the ones setting the policy, but I think the markets are thinking. I mean, there are a number of reasons for the markets to be a little bit more, or at least fixed income to be more bearish, because. So not just Trump, but, there's higher inflation seasonality going into Q1. There's a tendency for fixed income to sell off in the first quarter. There's a chance that if inflation stalls before the Fed's 2% target, they're going to have to just keep rates much higher. And then, it's not even clear to me that Bessent is going to be friendly to fixed income because, while he is trying to reduce the deficit, he has expressed an interest in issuing out the longer term. So more issuance in coupons is not fixed income friendly. So I think for all those reasons, there's a lot that could change. And usually when the markets differ from what the Fed's pricing in, I can, sometimes. I mean, I think in this case the difference is somewhat explainable by some of those factors that I've mentioned.
All right. Okay, Sam.
Yeah, I mean, I can side with Joe on a lot of that. I think with Bessent, there is some discounting there, right? Because he has showed interest in pivoting from bills to kind of terming out into longer coupon. I think there's a few interesting things going on there, right? Because yes, that is bearish fixed income, right? That is bearish on longer term debt. But we also recently have seen, that 3-month 10-year curve kind of start to turn positive, right? And I think that can aid in absorbing some of that supply because now you are getting positive carry out in longer term debt, right? And I kind of have to view this through the lens of cost of leverage, right? Because if you look at dealers, right, dealers' balance sheets, they've been kind of swamped with securities inventories, right? And their balance sheets have become more and more constrained. And we've seen this in swap spreads going negative, right? So that essentially increases the cost of leverage, and it increases equity financing costs as well, right? So now that that curve has gone positive, we get that positive carry that may also aid us in bringing back some foreign demand, because that's going to lower FX hedging costs. So maybe we see a little bit more of a demand for longer term paper, and that does free up some dealers' inventory, allowing them to absorb a little bit more of that issuance. But I think that if that doesn't materialize, that actually is a macro scare, right? I think that could be a shock that actually does cause a kind of equity correction here, right? And Nomura was out with a very interesting piece yesterday on the S&P negative breadth, right? We're now at 11 days in a row, which registers in the 100th percentile. There was only one worse occurrence, which was September 21st, 2001, where it was 12 days and the S&P was actually down almost 16% in that time. In this time frame, we're up 0.8%. So I find that very strange. And they had about the top 10 occurrences of negative breadth streaks. And this was the only occurrence that we had positive returns, right? And this is probably due to that concentration in, Mag 7, right? I believe they make up almost 36% of the SPY and almost 52% of the triple Q. So it's very scary, right? So you have correlation moving lower and you have long dispersion return showing strength. So if we do get kind of a macro shock on, let's say, one of these treasury refunding announcements, I think that could cause, kind of a catalyst for kind of an aggressive correction here in the market.
Maybe that's one of the unseen worries here, I think, down the line, is that yields and the elevated levels we are for the equity markets here, indices, and maybe the threat that poses, that's that unknown, maybe no unknown threats that we have for the markets for 2025, because it all looks pretty rosy now. I was listening to a Bank of America conference call, and they were said, look, outside of the mags, there's real value in some of the other components and some of the other companies within the S&P 500, for example, because there's that catching up to do. There is that gap between them and the mags at the moment, and if the mag starts running the form, it doesn't necessarily, in their opinion, if I get this right, doesn't necessarily spell doom for the index as a whole, because there's a lot of slack that we picked up by the other 493 companies, in the S&P 500, for example. So there is that. I mean, I've got a note here from JP Morgan Asset Management. They say they look for, or their title is sort of like policy fog, out of the cyclical storm and into policy fog. I think everyone's using, maybe excuse, but people seem to be using Trump as an excuse for blurring the lines on what they think about 2025, and even that accusation that this is inflationary and so forth. Some people are starting to pull back on that, from what I can see from some of the research pieces out there, and suggest there are offsetting factors to the Trump tariffs and the potential damage they could do on the upside to price growth. So I think his inauguration on the 20th is going to be a very important day in terms of where he sets out his stall, what he's looking to try and achieve in the first part of his tenure, second tenure in office, I guess. And then I guess that affects the next part of what we're going to come to here, which is policy for other central banks. Now, as well as the Bank of the FOMC tomorrow, we have Bank Japan and we have Bank of England rate decisions. We've had a number of rate decisions happening before year end. I want to quickly just look at Bank of Japan. They're expected to keep rates on hold, but there is a minority of market participants out there that think we could see a hike tomorrow from the BOJ, which would take the rate to 0.5%. Still, some say ultra accommodative, but moving away from ultra loose policy. Just in terms of what some of the banks saying, ING suggested that despite being a close call, it's expected the Bank of Japan they think it will hike next week. Experts at the Dutch Bank highlighted solid cash earnings, higher than expected inflation, and upper revision to GDP as contributing factors supporting the hike. They say we think that incoming business surveys, trade, and inflation data will also signal a recovery of the economy. But also, I've noticed, and it's Ueda gave the Bank of Japan governor Ueda gave a press briefing the other day, and also mentioned uncertainties externally. And so, in a sense, a lot of central banks are using this again as a kind of shield in terms of not giving too much foreign policy. Does anyone have any views on just, if not Bank of Japan in particular, but central banks in general, ex FOMC? Sam, do you have any views on anything?
Well, yeah, I mean, the BOJ, I'll be frank, I've never been able to really get a good read on the BOJ. Wage inflation has been rising over there. I don't foresee any hike coming this meeting. I think they're going to wait until the new year. And I think, they kind of play on the U.S. a little bit. I think they're a little bit better playing the waiting game than U.S. policymakers. So I think they're going to sit tight a little bit, wait to see what's kind of going on with the U.S. before they make a move. And I think if we're going to see a hike from the Bank of Japan, I think we eventually are. But I don't think that's going to come until the new year. I do not think it'll be at this meeting.
No, and I think that's people with that view. They'll wait and see in January. That's expected to be the right time that they'll move. Joe, do you have any views on BOJ, for example?
Oh, yeah. So I guess the 3 bips are priced in for this meeting and a cumulative 15 through the next 2 meetings. So, it's a close call as to whether they'll go in the next 2 meetings. I think it just seems like a lot of the central banks, with the exception of maybe the ECB, like they're just underestimating. It seems like they're constantly underestimating inflation because at some point, I mean, we have made progress since the COVID recovery on inflation, but it's not clear to me that we're just, in many countries that we're going to get to the 2% target that everyone is thinking about. And you kind of are starting to see it in some of the wage data. Like, I'm not saying wage data is going to spike, just that, that could prevent inflation from getting lower. I think, growth in the 3 countries that we're talking about, the US, the UK, and Japan, have all been good. And I guess especially for those foreign countries, there could be some additional price pressures if, their currencies weaken. I think this is probably going to be a theme for most of 2025 that, a lot of people are expecting inflation to come back down by the end of the year, but it's not clear to me that that's the case.
No,
Joe, I would especially insert too in the U.S. here, right? I think a big driver of the disinflation has been in that core goods category, right? And what's keeping it up has kind of been shelter, and we are seeing shelter come down, but it's a rather volatile series. But in the last few prints, we've kind of seen core goods start to rise again, and I think that could really kind of put a bottom in here in inflation as that starts to turn back up positive over the next couple of months.
Well, you've definitely seen that for the Bank of England today. We had CPI data out from the Bank of England, from the UK rather, and that showed core goods services have been sticky. That was expected, but we did see maybe core goods starting to just poke its head up there as well, and potentially cause an issue. Saying that, to counter that, we saw pipeline inflation, factory gate prices a little bit more, and therefore, down the line, I don't think that's been input into consumer cost baskets at the moment, consumers' baskets. Just quickly on the bank, we are looking at rates tomorrow at midday GMT. We're expecting rates to be held at 4.75%. And as George Buckley wrote, we believe the economic data weakening growth, but still sticky services and wage inflation justify a moderate pace of policy easing back towards a neutral range, which we think is 3.5 to 3.5%. We see that as a consistent with a quarterly pace of 25 basis point rate cuts from the bank, rather than back-to-back moves on the occasion of monetary policy meetings. Basically, on the occasion of monetary policy meetings is what they're saying. I wanted to get back to the point that Sam made about the neutral rate. Do you guys have parameters around, and it's a question I'd ask if I was in the press conference today. Where do you guys see neutral for the Fed? Do you agree with where the market is going on this? And where would you, from what you've read, or what you've heard from officials, where would you see neutral for even the high end of neutral range for the Fed? Joe?
Oh, well, I guess in today's dot plot, the markets are expecting the longer term neutral rate to be 3%. I actually think the longer term neutral might be closer to 4%. And I think it's just a function of a number of factors. I think we have a pro-growth president. We have we still have large deficits, and I think the markets are going to want more term premium to carry a 20 or 30-year bond. So I guess for a number of factors, I just don't know that we're going to get back to the pre-COVID levels, because you could argue that the pre-COVID levels are not the norm because of the great financial crisis, and that what we should actually look at are the rates from before the GFC. So it's not clear to me that this all this demand is going to appear for the longer end. Because I was looking at 10-year rate forecasts, and I was a little surprised that at the end of next year it's supposed to be at 4.13, and which is slower. So, well, I mean, it's like a few dozen bips lower from here, and I think it's more likely that as the Trump presidency goes on, that just the longer end just starts creeping higher in terms of yield.
Okay, Sam?
Yeah, I mean, I think Joe is right on that. I think the market, I mean, if you look at the 5-year, 1 month kind of SOFR rate here, I mean, that's at 3.7, right? So I think that's kind of a good gauge of market pricing of where the neutral rate is. And obviously that's what, if you look at the Fed's previous dot plot there, right, their longer run dots there are what, 2.87. So I mean, that's substantially higher to where the market thinks it is. So, we have also seen term premium kind of increase in the recent days too. I mean, just since December 4th, I'd say it's probably up about 7 basis points. You can't really say for certain what it is, but you can estimate it by trying to model it, right? And if you kind of model UST term premium right now, it's slightly under 100 basis points, at about 99 basis points in term premium. And that's just a guesstimation because it's kind of modeled. There's nothing really observable about it. You can't observe term premium, but you can model it. And I think the current market pricing isn't far off. I mean, 3.7 as a neutral rate, I mean, that would kind of line up with current expectations of where the Fed funds rate is kind of at the end of the year. And I think, a lot of it this year is going to depend too on where that labor market goes, right? Obviously, inflation is going to play a big role, but where does that labor market go? If labor continues to weaken, I think that's obviously going to push that rate lower. But if, labor is just normalizing here and we kind of hold steady here, then I do think that equilibrium rate is in that, let's call it 3.50 to 4% range.
So in terms of normalization, we're talking really, and I guess it's the pace of that normalization for the labour market. If it's in a steady and progressive manner, no panic, no worries. Do either of you see a recession in the future for the US over the next sort of 18 months, or is that now fully priced out of your thinking? Sam?
So sorry, could you just repeat the question, Henry?
Recession. But as I said, the assumption that we see the employment picture, say, weaken a touch, do you see any recession in the near future for the US economy?
At the moment, no. At least for the first half of the year, no. And I was in the recession camp towards the end of the year, but when that kind of the Trump presidency and they got the sweep, like Joe said earlier, that's going to allow them to really pass some things. So I think fiscal is going to be a little stronger, and that's going to continue to support growth. So I think it's going to have a difficult time seeing recessions in the next, let's call it the next 4 quarters here. But I think that's a risk that everyone needs to be aware of. I think there is some problems under the hood in labor, but I've always also been subscribed to the theory that it's very hard to see labor crack when you have an equity market performing well, right? It's usually the weakness in the equity market that starts to arise before labor cracks and not the other way around. You're not going to see a labor shock and then have equities react lower, right? I think it's going to be a function of a worsening economic environment, worsening equity backdrop that will eventually lead to unemployment moving higher. So I think, for the first half, the first half of 25, I'd still tilt odds that, growth runs above forecasts.
Okay, interesting. Joe, anything to add on that?
Yeah, well, so I agree that recession odds are low for next year. But I guess the thing I always tell my readers is that I guess with a volatile president, you just never know if that weird tail event could occur or not, because he is planning to make a number of large changes to the government and to policies, and he can be very aggressive when it comes to his negotiating tactics. And so while I don't think we will get a recession anytime next year, I think it never hurts to have some tail protection, especially when vol is as cheap as it is. So, I just think it's responsible when vol is low to, to add the tail protection in your portfolio.
That brings on to the good point, actually. I'd like to wrap up today, so thank you both for your participation. So tonight's reaction function, just quickly, Joe, where do you see markets looking for any kind of volatility, anything to grab hold of on such what we would say a well laid out sort of event today? Do you see any gaps in there where you may see some volatility in market reaction?
I'm actually expecting a very muted statement as well as a press conference. I don't think Powell wants to veer too much from expectations, at year end. So I'm not really expecting anything today. I think the market reaction will be quite muted.
Okay, cool. And Sam?
Oh, yeah, I'm with that. I think market reaction's muted. We're coming into December OPEX as well. Vol got a little bid the past couple of days into this meeting. It's still relatively low, but I think reaction's going to be muted, and things are probably just going to have a steady grind higher from here as kind of hedging around this FOMC event kind of decompresses, vol compresses. You get kind of those Vanna and Charm flows just off, event hedging. Probably just helps kind of grind the market higher, like we've kind of been seeing, kind of rangy chop, but slight tilt higher. I think that's kind of what we continue to see after today and into year end.
Cool. On that note, I want to thank you and wish you a Merry Christmas and a Happy New Year, and thank you for your contribution and your words today. I think we've got something from it today. Would you suggest then, just before we close, today is the last event that you guys will stick around for? You're not going to worry about the sort of data points over the rest of this week and next week, and you're going to forward. Just for our more, inexperienced listeners, in terms of the more experienced guys do, would you now call this a day after today and say, right, we're pretty much done for you, personally? Joe?
Oh, I'm sorry, Harry. I could not make out what you were saying. There's a lot of static on the line. Yeah, but I did want to wish all of your listeners very happy holidays and best of wishes for the new year.
Thank you very much.
Yeah, Harry, I kind of pieced it together. For me, yeah, this is pretty much the last day of the year. You know, it's kind of going to be one eye on the markets from here on out, but kind of take the time, enjoy the holidays, spend time with friends, spend time with family, get out, do some things. It's been a long year, so you got to kind of pack up shop a little bit and chill. So, you know, yeah, with that, all the listeners, you know, Merry Christmas, very happy holidays, and, you know, take some time off to relax and enjoy yourself and recharge the batteries. Cause I think, you know, the next couple of years are going to be pretty intense.
Amen to that. I'll keep it short and sweet because my microphone is rubbish. But again, thank you both for your contributions. Thank you guys for listening. And we'll be back early part of New Year with a better microphone and some more insights into what to expect from the US markets and markets in general. Thank you very much for listening, and Merry Christmas.
Thanks for tuning into the Live Squawk podcast. Your edge in the market starts here. Subscribe now.